Unit 2, The Economy, Lecture 5, Economic Indicators, Part A. Now we look at economic indicators. And economic indicators help us to gauge how economies and markets are performing. The more important indicators that we tend to focus on: gross domestic product, or GDP, private consumption spending, government spending, investment spending, CPI, PPI, and the balance of payments. Now we're going to look at who's interested in economic indicators and why. And the three groups of market participants and observers that we're going to focus on are economists and other market analysts, investors, and businesses. So for economists and other market analysts, they want to assess performance and judge the effectiveness of policies. They also want to compare across different economies, and economists tend to do forecasting. Investors, they are more interested in risk and return, and they would use these indicators to help in that decision-making process. And for businesses, they want to investigate new opportunities. Do they want to invest in a new capital project? Is there a new market that they want to enter? And so on and so forth. We're now going to look at economic indicators in more detail, and we're going to start with GDP, or gross domestic product. It's defined as the total value of all goods and services produced in a country in a particular period, and that period tends to be 1 year. Real GDP reflects total economic activity after an adjustment for inflation. Inflation only allows our money to keep pace with rising prices, so in order to get growth, actual real growth, there needs to be growth over and above inflation. So here we're looking at the actual components of GDP, and GDP is made up of consumption spending, spending by households, investment spending, spending by companies on capital goods, government spending on goods and services, and net exports. That is spending by foreigners in South Africa minus the spending by South African residents abroad. GDP information tends to be presented either quarterly or annually. The focus is on percentage changes. During periods of high GDP, which also tend to be periods of high inflation, interest rates will be high. So the impact on asset classes such as bond and share prices: bond prices will be low because interest rates are high, and share prices will tend to be strong. The growth in share prices because, of course, we have high profits. But because you also have high inflation and high interest rates, as we go forward, this will tend to cause falling prices. In terms of the exchange rate, there will be an appreciation because high interest rates will tend to attract foreign investment, and this will result in an appreciating currency. Private consumption spending, that is the total amount of money spent by households in an economy. And the spending can be broken up into different categories, including durable goods, goods expected to last more than 3 years, and non-durable goods such as food, clothing, and services. As for GDP, the information presented on consumption spending tends to be done quarterly or annually. Unlike GDP, the focus here is on real growth rates. But in terms of its impact on inflation, interest rates, shares, bonds, and exchange rates, its impact is similar to GDP. Government spending is the total amount of money spent by government on goods and services, services such as the defense forces, judicial system, and education, to name a few. But it excludes transfer payments such as pensions and unemployment. However, in order to look at total government spending, we have to include government investment spending as well. If we look at consumption spending by governments in industrialized nations, it represents around 15% of GDP. For other countries where the state provides a lot of services, it tends to be higher. So when we're looking at investment spending, or what is referred to as gross capital formation, we need to distinguish between fixed capital investment, which tends to be long-term in nature, and short-term or working capital investment. Now, when we're looking at fixed capital investment, we're looking at investment in property, either residential or non-residential buildings, construction work, infrastructure developments, machinery, investment in other equipment. Investment in short-term or working capital, for example, is change in inventories. This can be quite erratic, can be positive or negative. Be positive at a time when demand slows and production is more than meets the demand that the market has. And it's negative when demand exceeds the production capacity of companies. It represents only a small portion of investment spending. So for industrialized nations, investment spending tends to represent around 20% of GDP. And in terms of its features, it's the same as private consumption, except for the fact that it is referred to as a leading indicator in the business cycle. Now, a leading indicator is an indicator that becomes positive or turns upwards before the economy goes into a recovery phase.